All right, a quick look at the global market action overnight. Remember the much anticipated Fed meet giving mixed signals. We did see a sell-on news effect coming in. We've had the S&P 500 NASDAQ closing lower, while Dow's maintained somewhat of an uptick at about 0.6% higher. Let's look at Asia this morning as well and see how it's doing post all the news coming in. And those are, of course, your tech majors in the US, slightly mixed coming in there. And remember, Donald Trump wanted this rate cut, and it's the first one in 9 months. It was an 11-1 vote, with the sole dissenter seeking a 50 basis point cut. Importantly, there are indications that the rates may be cut by another 0.5% by the end of this year. The Fed chairman also raised some red flags. Let's listen in.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June.
Well, let's decode the Fed news for you. A big market trigger. Radhika Rao, ED and Senior Economist, DBS Bank Singapore, joining us this morning. Radhika, good to have you with us. As usual, the Fed, of course, giving mixed signals to the market. Clearly, they're also still wading through and trying to decipher the economic scenario. What's your key takeaway from the meet and the commentary?
Hi, good morning. Certainly very important meeting. Like you already mentioned, it's the first one in almost a year after they had cut about 100 basis points last year. And I think we were looking at 3 takeaways from the meeting. The first being, what is the move? We saw now a 25 basis point. Obviously, there was a small minority in the market who were of the view that it could be a more aggressive 50. The second was, how are they going to balance a weakening labor market, but signs of higher inflation? What you saw, in fact, is that the markets actually, when the decision was announced, you saw the dollar correct, you saw, market expectations switch towards expecting more rate cuts. But at the press conference, when we heard Chief Powell speak, then you had actually seen a bit of a drift back up, because there was then the view that they are not as dovish as it was expected. And the third point that we're looking for is how does the board actually vote? Do they vote towards a rate, how many of them vote towards a rate cut? And what you saw is actually one dissent vote by Mr. Stephen Miran. The rest of the team actually went for a 25 basis point. So these were the 3 takeaways, not as dovish as expected, as markets had anticipated. And we were looking for a 25 basis point, and that pretty much played out.
So, Radhika, help to decode this for some of our viewers in terms of, when it comes to those key economic factors that the Fed is eyeing. Is it once again the tariff impact that perhaps is leading to uncertainty and some amount of hawkishness from the Fed?
Yes, certainly. I think there is no dearth of pressure from the government, but I would think that the Fed is trying to, take a more center path because they are facing a very, I would say, a divided economic backdrop, where there are not clear signs that rate cuts are required because their own growth projections have actually been dialed up. Unemployment rate, same for this year, but next 2 years it's been, broadly in the 4% handle. Inflation numbers have also been dialed up. So the backdrop that they have presented with is quite divided. So I think that's why they are trying to take a path through the center. Tariff impact, for example, we do think it is still going to play out in the next 3 to 6 months at the least. So we haven't really seen that feed through right now. If you see the inflation breakdown, you're seeing pressures from some part through services, some part very selective goods that seems to be showing the pressure. So the tariff impact per se is likely to only show in the subsequent 1 or 2 quarters. So So yes, certainly to your point, tariffs is an important watch factor. Balancing the pressure from the government is another. But I think in midst of all of this, a cautious approach, a data-dependent approach, certainly makes a lot more sense, and that's why they're going with 3 rate cuts, including 25 basis point that's already been delivered, and perhaps one more in 2026.
So one more in 2026, I think the market is going to immediately price in. But Radhika, forward looking from that, given what they're anticipating or the commentary that you heard, do you feel the Fed will stick to it? How much do you feel we're going to really see again a wait and watch kind of scenario? And also, what's your understanding of how the impact on the currency will play out as well?
Sure. So our own, house view is that the markets are pricing in a 3+3, essentially a lot more aggressive rate cutting cycle from the Fed, versus what the Fed is saying, which is going to be a 3+1, which is that they cut this year a little bit 2026 and then they hold. We are leaning towards what the Fed is saying, which is that we expect 3 this year, including what was delivered, and 1 next year. And for the dollar, our view, our FX strategist view has been that the dollar is likely to trend down. He did anticipate a bit of a consolidation in May, July, August kind of timeline, because a lot of negativity that was in the dollar was just about playing out. But hereafter, we do expect further dollar softness into the final quarter of the year.
All right, great. Radhika, thanks so much for joining us and helping us understand and decode the Fed's commentary as well as the impact going forward.